Okay. Good evening. Welcome to tonight's Pension Fund meeting. My name is Councillor Ross Melton, Chair of this committee. Before we begin, there are a few housekeeping points to cover. Please can I ask officers to introduce themselves before speaking for the first time. This meeting is being live streamed on YouTube. By taking part, you are consenting to be recorded. If a fire alarm sounds, please leave by the nearest exit and take instruction from security officers. The assembly point is located outside St Peter's School, which is in the front of the building and to the right. Apologies for absence, item 1. I've received apologies from Councillor Hogan and Councillor Pascu Tilbury. We hope that Councillor Painter will join us shortly. Declarations of interest. Can I ask members if they have any interest to declare? Items for discussion today? Excellent. Minutes from our previous meetings. Can I ask members to approve the opening statement? Thank you. And let's get into the meeting. Eleanor, if you wouldn't mind kicking us off with item 4, key performance indicators, please.
Thank you, Chair. So this paper sets out the key performance indicators for the period September to December 25, quarter 3 inclusive. The KPO performance is highest level since our partnership with LPPA. So the overall performance of 99.7%. This is alongside a higher number of completed cases, meaning all case types have performed above targets of process within their SLA. Lowest performance cases were seen in death cases and deferred retirements. The challenges there is insufficient evidence with the bereavement team, so having to push that back and hence taking longer to process, and sometimes traces required in order to find the beneficiaries. In terms of deferred retirements, the issues there are with regard to gaining the full service history from previous employers. LPPA's help desk also saw the average wait time fall for quarter 3 to 1 minute 56, so our lowest all year, and the abandonment call rate of 1.4, again lowest in the year. So a really good quarter in terms of LPPA's performance. I'll welcome the question.
Well, just having read it in advance, that looks like continued improvement in performance, both in administration and delivery, I think. So I think that we should welcome that and thank staff for their work on it.
Thank you, Karen.
I'd echo that, and a real credit to you and the team. I recall that at our previous meeting, this was not the trend that we were anticipating. There were some concerns that LPPA would be diverting resources to other projects. Can you give us a bit of an insight on how this performance has been achieved?
Thank you, Chair. I think it's mainly down to a focused effort on wanting to sustain that and knowing that their clients are nervous about the impact of all of the new legislation that's coming and whether that service will be consistent. What they want to do is focus on automation and improving that service delivery, changing that reliance on resources, which is hard to retain, takes time to train and follow through in terms of what we see in terms of that quality. And so they have been very focused in, we've got a dedicated person that headlines any issues in our fund. I think that's really helped because they take ownership of a Hammersmith and Fulham fund as opposed to it falling into anybody's hands. And so that concerted effort, I hope we will see follow through during this rapid period of transformation with the LGPA.
Excellent. No further questions? I think then the only point to note, Eleanor, is just as we are quick to highlight our concerns with LPPA, we should be equally quick to praise them. So even my personal positive feedback.
Will do, thank you.
Can I ask members to note the report? Excellent. Moving on, staying with you, Eleanor, on item 5, pension issues.
Thank you, Chair. So this paper sets out the key activity in the pensions administration operation function. So complaints are pretty steady. Actually, in quarter 3 they were around 13. That's actually down end of February to just 2. So Again, marked improvement there. The complaints previously were around transfers, whereby they weren't managing members' expectations, and so that frustration, that's a long process. There isn't that much control, but by keeping members informed, it manages their expectations, they're less likely to complain, and they know what to expect in terms of timelines. They were 13 opt-outs at the end of Q3. Just to note, opt-out reporting will become mandatory in report and accounts going forward as part of legislative changes, and that's to assist ministry with identifying trends and aiding with auto-enrolment policy. So that is something that the government themselves will be designing, ministry themselves will be designing an opt-out form that we will have an obligation with LPPA to signpost our members to if they wish to opt out of the fund. LPPA are also engaging in Q1 of 26-27 in a data cleansing exercise. That will cost the pension fund an additional just over £5,000 net to identify contact details for deferred members. About 3,000 deferred members that they'll be carrying out that exercise for, and that's because of again legislative agenda to have a data improvement strategy. So the core of what we do is the data we hold. That's right across from admin right through to the admin, the investment. Sorry, if you don't have that understanding of who your members are, what your liabilities are, then you can't then plan and make sure that you're in a surplus or deficit position, and then what that makeup of your membership is. And so the regulator, as well as ministry, are pretty much more focused on funds and LGPS funds in terms of that data clarity and quality. So there's been lots of outcome information on the outcomes of the consultations, and that reform will have significant impact on the fund, but also on members' benefits. So we'll be doing some work later in the year on how that improvement looks for members. So there'll be lots of communication engagement pieces that I will share with the committee outside of the site, probably because we're not meeting till June, on what that looks like. But certainly things like the impact of opting in for elected members and mayors into the LGPS fund, that will have an impact. That takes effect with May, and some of the reporting that will come through in evaluation in terms of that pension gender gap will also be following through. So it will be a very different landscape going forward. Welcome any questions.
It's positive, isn't it, about the employers? There are some issues I just wanted to raise about members, because, and I know this sometimes comes when you ask people, sometimes get more, not negative responses, but not such positive ones, but you picked out in your summary that we have had some dissatisfaction with members and also some complaints. So I wondered what has caused that or what we're doing about that. Is you raised it? Is that a trend, or is it something that's going on at the moment because of what's happening nationally, or is it something that we can quickly improve on?
So, thank you, so we'll always get complaints, so that people always will be, and that's a complaint more formalised ones as opposed to dissatisfactions. And it's the core of, so I have quarterly meetings with LPPA solely on complaints, and the core of that is communication for me. That comes out loud and clearly each time, is that actually they could have just communicated better with the member to explain the process, to explain the timeline, and therefore manage their expectations. It might not change that they would have to wait longer or that there were issues, but actually the member would know and would have an understanding. The number of complaints has not increased, it's actually gone down. We were in a place a few years ago where it was double figures, I'm talking 20s or 30s, and we're now far away from that, as I say. just had the results today for end of February, where there are only 2 complaints on the fund. So we are in a much better position. They are better at resolving issues so that they don't become a complaint in terms of a dissatisfaction, knowing when a member is unhappy. But they will still happen, and it's how they manage those. The feedback and the sessions that I have quarterly solely on complaints, they do go back to the team to look at those issues and to work through the lessons learned in order to mitigate against this happening again in the future.
Okay. I've got one sort of follow-up to that, or observation about communications. I think you've talked about the fact that you communicated the impact of the cloud remedy. I'm still struggling with myself, but there we are. But I'll just do this, Chair, if I may, at this point. I've attended various training for this role, and I have to recommend the tri-borough training, which I was on again recently, very good indeed, and also the SPS. I don't know what that stands for exactly, but they do excellent training. And I'd just like to say, last night I attended when Phil Triggs was speaking, and Eleanor was there, and others. But I noticed there were more councillors there from across London, and actually spoke to me afterwards because I asked my question, as I often do. But I just think that that's important. So my point about communications then is this the right place to ask it? Are we going to be able to communicate, or know, if we know, simply, to our members what the changes are with pensions fund bill? Or is that something that's going to come much later on? Because actually, I have been asked about this by members. What's this mean for me? And in many ways, some of that was resolved at the training, because I asked that question, and people say, well, contributions aren't going to change, and so on. But I just wondered at what point, and whether that's the way you do it. I don't know. How do we, because it's a big change, isn't it? It's a significant change. And I'm not suggesting we need an answer to that tonight. I'm just raising it because you talk about communications, and I totally with you. I think any good organisation is as good as their communications. I really do. So, and I think we pride ourselves, certainly Hammersmith and Fulham, I think we try being good communicators. So if there's any opportunity to think about that moving forward, not alarming people, far from it, but just recognising that there is a change. I mean, whatever, I don't know. And to reassure people that actually, whatever, I don't know. But it is out there, and therefore if we don't do something about it, I think we're in sort of dereliction of our responsibilities. But I understand timing is crucial, or not crucial, but it's very important. We don't want to get the wrong message out there or alarm people unnecessarily. But what I'm saying is, if we don't communicate something about it, I think we could be asked later on down the line, well, why didn't we say it? So that's why I'm raising it now. And I'm raising it really, as I often do, because I don't really know the answer. And I'm not suggesting that you know the answer either, but I'm just raising it. Okay?
So thank you, Councillor. So we are planning to do some communication in-house at Hammersmith and Fulham. We have a session that's called Wellbeing Wednesday. And so I've launched a sort of a financial wellbeing hub. And we will be rolling that out later in the year. So don't forget a lot of this, although we know that the outcome's coming, it hasn't received royal assent. So we have to be careful about when we launch that. But certainly that is in the planning. I'll be speaking to the learning and development team about how we launch that. Will also be stuff on the website, and LPPA will also be doing that. So there'll be a whole tranche of changes. We'll have to change some of our processes. LPPA will have to change the most because they obviously process the work. But just to be clear, the changes are for the better of the member. So it's much more about fairness and protection for members in terms of the provision if they are on additional maternity leave, in terms of taking sabbaticals, in terms of if they have a cohabiting partner. Those rules are made much fairer for individuals. So that there is nothing there that would mean that somebody's disadvantaged. The only piece there, I suspect, might cause some feedback is the change to the minimum retirement age, and that the ministry is still working that out. So they've actually put in the changes to take with effect in phases. So phase one, which is this year, and then there'll be later this year, I think post May, there'll be launched to phase two and the implications there, because there's lots of different scenarios in terms of individuals that might have joined after a particular date, so November 21, and those that have transferred benefits in, etc. So that's with the minimum retirement age. It's much more complex than the ministry first thought. And in terms of the benefits for the scheme, it's to make it fairer, to prepare for the future makeup of the population, to make sure that their pensions provide for their future. So that's the intention. So it's all in the interest of the members.
Thank you. It seems very well. That's well in hand. But I think it's an important point to raise, Chair. That's why I've raised it here.
Absolutely welcome intervention. And I suspect we'll read the pension bill.
Thank you, Chair. Peter Parkin, thanks, Eleanor. Do we have, in respect to the cloud remedy that Councillor was referring to, do we have many members that have come to you for clarity on that? Because I quite agree with Councillor. It's very confusing. And have you, you said that they started to pay out PTA. Do they know how that's working through?
So the McLeod remedy affects a very small number of membership, and those that it does affect, it affects them to a very small degree. So I think last year I confirmed that we had 2 members that it affected, and that they were due more pension, and the highest level was £21.
Right.
So it's a very minimal impact. A lot of work for very minimal impact. And it's only when someone comes to retire that they know the true impact of that. But LPPL are well equipped to deal with that, and it has a bigger impact on other public sector schemes like fire and police as opposed to LGPS.
Thank you. And supplement to that, do you know anything about the pensions dashboard for members? It just seems like it's going on, and it's never going to get to a light, a tunnel, or anything. How's that going? Or you can't comment.
Thank you, Peter. So we haven't had anything from in terms of a go live date for members, so it's still muted at 2027. The connection date for ABC schemes or private schemes is next year, and so later this year. And so until they are all connected, we are aware of where the impact of that thereafter in terms of the go live. So the group that's heading that up may feel that actually there's other issues they haven't thought of, and therefore they may push that back. But the only thing I will say is they have asked for a working group. So they are going through different stages of working groups, and they're on the second phase of a working group to actually interact with the system. So any feedback I get from that, I'll obviously share with you.
Thank you, Chair.
Any further questions or comments on that? Excellent. Can I ask then members with no report? Thank you. Pushing then on to item 6, triennial valuation. Sharon, if you wouldn't mind.
Thank you, Chair. Sharon Cogley, Pension Fund Manager. This paper presents the results of the latest triennial actuarial evaluation of the Hammersmith and Fulham Pension Fund, which assesses the fund's funding position and sets employer contribution requirements for the next 3 years. It provides an important update on the fund's financial health and its underlying assumptions. And I will now hand over to the fund's actuary, Stephen Scott, who joins us remotely, to take the committee through the valuation findings and implications in more detail.
Thank you, Sharon, and good evening, members. Good evening, everyone. It's a pleasure to be with you this evening, albeit remotely. My name is Stephen Scott. I'm a partner at Hyman Robertson, and I'm your fund actuary. So I'm here today to give you the update, which is the results of the 2025 valuation. Included in your papers this evening is my final report on the valuation. Now, I don't have access to your restricted papers, so when I'm going through this report, I'll make reference to the page numbers that I've included in my report. Hopefully, you can follow with that when I'm going through the update this evening. The report that I provided in the papers is the final report for the valuation, but it's currently in draft. There are a few final minor updates to be made to the report before this is signed off before the valuation deadline, which is the 31st of March later this month. If we turn first of all to page 4 of my report, what I have in here, this is the executive summary page, is a summary of the valuation results at the 2025 valuation compared to the position at the previous valuation in 2022. On that page on the right hand side, we can see a summary of the funding position, and what that's doing is showing the position, first of all, the 2022 valuation on the far right of the table, a funding level of 105%. That corresponds to the value of the assets, just over £1.3 billion, being slightly higher than the value of the liabilities at that point in time, just under £1.3 billion. Fast forward to the 2025 valuation, the value of the assets has increased to just over £1.4 billion, and the value of the liabilities has reduced slightly over that period to £1.25 billion, which corresponds to a surplus at the 2025 valuation of 161 million and a funding level of 113%. So, an improvement in the funding level over the 3-year period. I'll explain shortly the key drivers for that improvement. But what we can see just from this page is that's due to an increase in the asset value and the liabilities remaining at a similar value to the previous valuation. On the left-hand side of that page, we can see the resulting contribution rates. Now, what I'm showing here are the average contribution rates across all employers, so the aggregated rates. At the 2022 valuation, we can see the aggregate rate across all employers was 21.8% of pay. And then as we look at the position following the 2025 valuation, we can see that the aggregate contribution rate has fallen from that level to of the order of about 19% of pay, and it will fall gradually over the next few years. So we're seeing a reduction in contribution rates. That's due to higher future anticipated investment returns, which I'll explain shortly. And also it's partly due to that improvement in the funding level, and we're seeing a bigger reduction in contribution rates because of that. So we're reporting a positive position at the 2025 valuation, and the benefits of that will be felt by your employers through reduced contributions over the next 3 years. I should have said at the start, please ask questions as we go through, if you would like to do that to improve your understanding. The next page I was going to comment on was page 11 of my report. And in this page, what I'm showing here is the reasons for the improvement in the funding position over the last 3 years. What I'm showing here is called a waterfall chart. And we read this chart from left to right. So if we start at the left-hand side of the chart, what I'm showing here is the position reported at the 2022 valuation, and that was a surplus of 58 million. Each item to the right of that then is a reason why the funding position has changed since the 2022 valuation. Now, the first half of this chart shows all the effect of things that have happened over the last few years. So we've called that known events, that's experience. And then the second half of this chart shows the effect of changes in future expectations, so changes in the actuarial assumptions underlying the liability measurement. Now, over the last few years, there's a couple of numbers I want to pick out here. The first of those being what we've called excess growth in assets. That shows a negative number of 51 million. And in effect, that's the result of asset performance being lower than the assumption set at the previous valuation. What that means is that the value of the assets, whilst higher today than they were at the 2022 valuation, are lower than what we would have had projected had the assets performed in line with the valuation discount rate. The most significant item in there relates to benefit increases. That's a negative of 144. And what that means is that pension increases for members over the last 3 years. So we had a 10.1% increase in 2023, a 6.7% increase in 2024 as a result of high inflation, and then 1.7% last year. Benefit increases have been higher than the assumption set at the previous valuation. Now, that's positive for members. Their pensions have been increasing in line with inflation over that period, but it does mean the liabilities are higher than what we would have projected at the previous valuation. Now, the key point here and why I'm focusing on this is that if we add up the effect of all that experience since the 2022 valuation, and if we had made no changes to the assumptions, then we would be in quite a different position at this valuation. I would be reporting a deficit position to you today of £153 million. So would be at the funding level would be less than 100%, and perhaps we wouldn't be reducing contribution rates. However, as is normal, every time we do a valuation, it's important that we reassess the actuarial assumptions, and we've made sort of 3 changes to the assumptions, which has brought the position back into a surplus. The first of those relates to the inflation outlook. So at the 2025 valuation date, inflation expectations were lower than what they were at the previous valuation, so that leads to a reduction in the liabilities of 90 million. Other assumptions, what I'm referring to there are changes to the assumptions, for example, around about life expectancy, but more relevant here, changes in the assumptions for how the proportion of members that are married. So we've realigned that assumption based on evidence, and that's led to a further reduction in the value of the liabilities. The key item here, however, relates to the allowance for future investment returns. And what we've seen since the 2022 valuation is an increase in asset return expectations across all asset classes. And if we consider, as a sort of proxy for the risk-free rate, how the yield on government bonds has increased over that period. So the yield on government debt increased from about 1.7% at the 2022 valuation to 5.2% at 2025. So a significant increase. Now, the fund doesn't hold government bonds in order to pay pensions. You invest in riskier assets in order to generate a higher return. And so it therefore follows, if we're seeing a higher return expectation on low risk government bonds, then we're seeing that return expectation increase, then we should expect to see a higher return on the risky assets that you invest in. And it therefore follows that the assumption that we are setting for future investment returns should increase at the 2025 valuation. And we've done that. So we've made allowance for that at the 2025 valuation, but we've also increased the level of prudence underlying those assumptions. In effect, we're sort of taking a less account for those higher investment returns than we would do otherwise. We're taking a sensible allowance for higher investment returns than we did at the previous valuation. And I'll touch on that shortly when I look at the assumptions in a bit more detail. The key point here before I move on is that allowing for those changes in the assumptions puts us into a position where we're reporting a surplus in the 2025 valuation of 161 million, and that's positive. But we should apply a cautious eye when evaluating that funding level. Clearly, that's based on an assumption that we're going to generate higher returns, and if the fund doesn't generate those returns in the future, then that surplus won't materialise in the future. So it's important, we continue to monitor the position. We'll do the next valuation at 2028, and I know you keep a keen eye on the funding level at each quarter in between actuarial valuations. A lot more detail in the valuation report on experience, and happy to take any questions on that. What I was going to do now was just very briefly go through some of the appendices in the report and just make a comment in respect of each of those. And again, happy to take questions as we do that. The first appendix we have, it relates to the data. I'm not going to go into this in any great detail, simply to say that the data that we received for the purpose of the valuation was, well, fit for purpose. The data was provided in good time by your team. It was very high quality and, with very little amendments required in order to use that for the purpose of the valuation. So this is really important. No concerns about the data provided, and that was fit for purpose for the valuation. So I thank you to your team for providing the data in such a good condition. In Appendix 2, we have the assumptions, and what I'm going to refer to here, there's a lot of actuarial detail in here. I want to make reference directly to the change in the discount rate assumption at the 2025 valuation, and you can see that at the top of the table. So at the 2022 valuation, we set a discount rate of 4.4%. There's then in brackets 67% likelihood of success. What that means is that we assessed there to be a 67% likelihood the fund would generate that level of return over a 20-year period. Now, at the 2025 valuation rate, we've set a higher discount rate assumption, 5.3, but crucially, we're assessing that there's a much higher likelihood the fund will generate that level of return. So whilst we are increasing that discount rate assumption, we believe there's a higher likelihood that the fund will generate that level of returns. And essentially by increasing the required likelihood of generate that return, what that is equivalent to is us applying more prudence within that valuation assumption. Okay, if we had assumed that, if we had said about a sort of a hurdle rate of 67%, so if we said we want to set the discount rate assumption so there's a 67% likelihood of success, then the discount rate assumption would be something like, you know, close to 7%. But the view expressed, that the advice that I've given to the fund is that it would be inappropriate to do that, given some of the sort of the market volatility, market risks, and in particular at the time, concerns about geopolitical risk. We thought it was reasonable to increase the level of prudence within those valuation assumptions. And actually, when we see what's transpired over the last few weeks, I think that sort of provides credence to that decision to increase the level of prudence underlying the valuation assumptions, because, you know, depending on what happens with the position in the Middle East, you know, then, you know, that could have an effect on returns, you know, over the short or long term. So active decision taken to increase the level of prudence and evaluation, but we're able to do that while still showing an improvement in the funding level and reductions in contribution rates for employers. In terms of the remainder of the appendices, and I'll be brief, the governance audit trail provides detail on the key sort of processes followed during the valuation in terms of the advice that has been provided and the approach taken to provide results to employers. In Appendix 4, we've got information on there on climate change scenario analysis, which is a requirement of the valuations now. It's something that GAD require as part of their Section 13 work. So we provided an indication there of how the funding level could change depending on specific future climate scenarios. And the key point here is that none of those scenarios lead us to be concerned about this risk in terms of having to sort of amend funding strategy or set higher contribution rates to mitigate that. You can see under all scenarios we're still over 100% funded. Section Appendix 5, we have details required by the government actuary so they can do their consistency check as required under Section 13. So GAD will carry out an exercise to check various elements of the valuation, carry out their scrutiny, and this is the information that GAD require in order to do that. All funds are required to report the same information, and what we'll be doing in the springtime is collating all of that information ourselves and then providing our own analysis and reporting on that in May, so we can provide a definitive position to the LGPS, showing funding levels across the LGPS on a like-for-like basis, so you can see how you compare to other pension funds in the country. Final really appendix, well, two more comments. The rates and adjustment certificate is set out in Appendix 8. On there you can see the contribution rates that have been set for individual employers. There was a comment in one of the administration reports about the process taken to explain the funding strategy to employers. I think there was only one comment back from an academy which we responded to, and we've had some dialogue with the Department for Education in respect of the funding strategy for academies, and I think we're of the opinion that they're satisfied with the response that we provided there. Contribution rates are falling across the board in response to that positive funding level, and what you may notice on there towards the end of the rates and adjustment certificate is that some employers will be paying a nil contribution rate over the next 3 years. These are employers who we expect to cease participation in the short term. When those employers do cease, then the fund need to make what's called an exit credit determination, and there's a scenario where the fund would have to pay an amount back to the employer. What we want to avoid, we want to avoid that, and therefore by setting a nil rate, we're reducing the likelihood that the fund would have to pay a refund back to the employer at that future point of cessation. Final comment from me on this, and happy to take questions, related to the gender pensions gap. So this information will follow. It will be included in the final valuation report. We'll report on the gender pensions gap for the fund. And again, this is a new requirement at the 2025 valuation set out by MHCLG that all LGPS funds should report on this. So we'll make sure that the fund comply with that in the final report. Any questions on any of that?
Thank you, Stephen, for both a comprehensive report and for that summary. I had a question about the relationship between the discount rate and probability. Have I understood it correctly in reviewing the appendix earlier today that the discount rate is higher, so there's an assumption that impacts could be more severe, but the probability of those is forecast to be lower. Is that correct?
Well, yes. So sorry. At this valuation, the discount rate is higher. So that essentially means we're assuming the fund will generate a higher level of investment returns per annum than it was expected to back at the 2022 valuation. So we think you're going to generate higher returns in the future. But also alongside that, we think it's more likely that the fund will generate those higher returns than we did back at the 2022 valuation. Now, if we had assumed a consistent level of prudence, then we would be making an assumption of even higher returns at this valuation. But yeah, my advice, that wouldn't be appropriate. There would be a risk that the level of returns we were assuming in the future actually wouldn't be achievable. Now, a model may show that you're likely to generate that level of returns in the future, but when you sort of overlay some, real life on top of that, when we think about, market volatility, when we think about geopolitical risks, when we think about inflation risks as well, then that led me to a recommendation that we increase the level of prudence and therefore reduce that discount rate relative to what it would have been.
Thanks, Scott. Still learning things. Right.
Thanks, Mike, and Court's member. In my experience of being on this committee, I say increasing the discount rate by 0.9 is quite a big increase. Obviously, government bond yields have gone up quite a lot since 2022, as you point out, but it does seem to me to be quite a big increase. And one thing that I'm not sure if I'm following it correctly is that you said on your bridge chart that lower inflation than expected is a contributory factor to the better position. But I would have expected if the bond yield is higher, that's in good part because inflationary expectations are higher than they were. So how do you reconcile those two factors?
Yeah, thanks for that question. In terms of the increase in the discount rate, it is a big increase. 0.9% is a big increase to make from one valuation to the next. I would say that, and we don't set strategy based on what other funds are doing, but the increase that you're seeing on your discount rate is actually far lower than the increase that a lot of other funds are seeing, and that's because of the additional prudence that we've applied within that discount rate. I think if we were to apply a lower discount rate at this valuation, so we're at 5.3 at the moment, we would lose a little bit of credibility, I think, in particular with employers, because what we would then be doing is setting our discount rate assumption almost exactly in line with the yield available in government bonds. So essentially, we could be saying that, we're making no allowance for investment returns over and above the risk-free rate over the 20-year period. And I don't think that would be appropriate. And so I think, where we've landed on the 5.3 and that 83% level of prudence is appropriate, albeit I completely take the point that it is a big increase relative to the 2022 valuation. But I think it's at the right level. In terms of inflation expectations now, when we look at long-term inflation expectations at the 2025 valuation, they're not that dissimilar to what they were at the previous valuation. The big difference being that at the point of the 2022 valuation, there was an expectation of higher inflation in the short term. So we were just coming out of COVID. The 2022 valuation took place, I think, essentially the month after Russia invaded Ukraine. And when we looked at the market price of inflation at that point in time, there was an expectation of higher inflation in the short term, and that fed into that inflation assumption that we set at the 2022 valuation. Now, inflation was even higher than the assumption set at the 2022 valuation, but the reduction that we're seeing in that future expectation since 2022 is really just simply because we don't have the same expectation of higher inflation in the short term.
Sure. Well, just to come back on that, I mean, I think it's hard to argue that higher government bond yields are not. And that's across the whole curve. I mean, they're over 5%, aren't they, at the longer end? That isn't due to expectations that inflation generally will be higher than previously people thought. I guess the other point is that this is effectively the data you're working off of March 2025 is pretty much exactly a year old now. So what, if anything, has happened in the last year that either supports or challenges the assumptions that you've made?
Yes, again, thanks for that follow-up. I mean, one year period is probably too short to sort of to use as a basis for assessing the appropriateness of the assumptions. When I'm setting the assumptions, I'm doing so, based on expectations over 20 years. That being said, when we do look at experience over the last 12 months, it's actually been pretty much in line with the assumption said. Investment returns over that period have been positive, notwithstanding the slight reduction we've seen in returns over the last few weeks. The level of returns achieved has been broadly in line with the discount rate assumption set, for the purpose of the 2025 valuation. I can't take the credit for that. It's I'm looking long term, but you should take comfort in the fact that the funding position now is probably very similar to that which I've reported here in the valuation report based on market conditions 12 months ago.
Okay, and just a final one, the 113%, that's quite a bit lower than some of the numbers that we've had reported to us over the last year or so, which have been in the range of 125 to 140 or maybe even higher. Is that because we're not comparing like with like, or has there actually been a like-for-like decline in the surplus over the last 12 months?
Yeah, again, thank you for that question. I should have made that point clear during my presentation. So you're not comparing like for like there. In the updated reports you've been receiving, the discount rate assumption underlying the value of the liabilities in those is based on that 2022 valuation assumption. So based on that 67% level of prudence. So the discount rate assumptions there will have been higher than what we've set formally for the 2025 valuation. And that's why you're seeing that step change, because it's not been done on a like for like basis. If I was to measure the funding position at the 2025 valuation on the same basis as 2022, allowing for that 67% level of prudence, we'd be reporting a funding level of about 140%. But that decision to increase the level of prudence for the reasons I've set out leads to a reduction in discount rate, it leads to higher liabilities, and it leads to the reported position 2025 rebased position of 113%.
Other questions?
Stephen, how you mentioned briefly, well, maybe you didn't, but you mentioned that there was some talk about measuring against other funds.
Yep.
Is that in this report, or is that going to be done in your final report?
Yeah, happy to elaborate on that. So when I mentioned that, I was on Appendix 5, and what's included in Appendix 5, yes, it's information showing the funding position for your fund on a standardized set of assumptions. Essentially, these assumptions are set by HM Treasury. The Government Actuary Department requires the position reported on those assumptions by every LGPS fund in England and Wales, so they can then carry out an analysis to identify. Part of that is to compare LGPS funds and see where they rank next to one another. Now, it's not for the purpose of saying this is the best fund, this is the worst fund. It's so they can scrutinise the decisions taken at a local level and form an opinion on whether the funding plan that's been put in place is appropriate or not. Now, on the Appendix 5 of my report, you'll see a figure in there on the second page of that appendix showing it's called the funding level on the SAB basis. So this is the basis used by the Government Actuary. That's 103%. So when I measure the position on the standardized set of assumptions, I get a funding level of 103%. Now, that's lower than what I'm reporting in the funding valuation, but there's no need to be alarmed or concerned by that. The assumptions that are set for the purpose of this consistency work that's carried out by the Government Actuary are not appropriate for the purpose of setting contribution rates or for carrying out a funding valuation. So that information is useful. But it's only really of use when you use it to compare funds on a like-for-like basis.
Thank you. Thank you, Mark. Stephen. Thank you, Chair.
Excellent. Thank you very much for clarifying those points, Stephen. Very much appreciated. Members, can I ask that you approve the final triennial valuation? Approved. Can I ask also that you, Stephen mentioned that there were a few final tweaks and changes that may need to be implemented over the coming weeks prior to the 31st. absolutely delighted to Phil and myself the opportunity to approve those reviews. Excellent. Thank you very much for your time and for your work, Stephen. Very much appreciate it. And lovely to see you again after our conversation a couple of years.
Yeah. Thank you.
Pressing on then, and staying with you if you wouldn't mind, Sean, with item 7 on strategy statement.
Thank you, Chair. This paper presents the funding strategy statement for the pension fund, setting out how employer contributions will be determined to ensure the long-term solvency of the fund and the prudent funding of member benefits. It also reflects stakeholder feedback received during the consultation period, and I will now hand over to Ellen Dennis to briefly cover anything further that she'd like to add on the consultation process.
Thank you, Chair. So, as Stephen touched on, we have a very small number of responses from employers. The main one was from one academy that challenged their stronger funding level without any reduction in employer rate. And after discussion with Stephen's team, we went back to them with agreeing with a 1% reduction for each year, given their funding level, but with the proviso that should our funding position as a fund change, they may well find themselves having to pay higher contributions as a result of the 2028 valuation. But because of their budget constraints, they were comfortable with that eventually. There was some resistance of why that wasn't a higher reduction, but the actuaries gave a very comprehensive response in terms of that prudent approach, and no guarantees for future investment performance going forward. Other schools came back with further clarification on the process, on understanding the funding strategy, understanding when the contribution rate commenced, and also ill health implications. So very general questions on the valuation. As I say, there's only one academy that had issues regarding their contribution rate, and actually because they were the lowest rate paid, the actuary also agreed that another academy in a similar position that hadn't raised the issue should also benefit from that reduction. Nothing further there, unless there's any questions.
Just one point of information, most recent legislation on schools, which is basically to do with special educational needs, does actually say that all schools need to be part of an academy chain or academy process. That's local authority schools. So I'm sure we're aware of that, but there might be some implications structurally that might come your way on that.
Thank you, Councillor. So one of the points in the new legislation is regarding multi-academy trusts, whereby the centralised head office in effect can dictate which fund all of its academies belong to. And so there are implications there. I don't know if Stephen wants to add anything there, whereby what we may find, we're a relatively small fund, but in the grand scheme of things, what you may find is perhaps one academy, multi-academy trust that has schools in Barnsley and Northumberland, I think was the example used, and actually the head office is in Barnsley. All of those academies as part of that trust can actually be in the South Yorkshire fund. And so what's the impact of that to the Northumberland fund if all of those academies are no longer contributing? And so that's more about how that plays out going forward in terms of the funding and the number of members contributing. I think Councillor Toubrey has mentioned that about is there any issues that we need to be aware of in terms of contribution rate. His question was more about salary sacrifice, but there is implications to pick up on his point with regard to how many employees we have paying into the scheme as opposed to members.
Thank you.
Any further questions? Perfect. Unless there are any further observations, can I ask members to approve the draft funding strategy statements subject to delegating any amendments or changes to Phil and myself? Thank you. Staying with you, Sean, on investment strategy.
Thank you, Chair. This paper provides a high-level overview of the fund's current investment strategy and sets out the key strategic themes and considerations to inform the forthcoming full investment strategy review in light of updated funding positions and market developments. It is intended to guide the committee's discussion, and I will now hand over to Izio to take members through the key themes and considerations in more detail.
Thank you, Sharon. Thank you, Chair. Introduction, Johnny Moore, Izio, Investment Advisor. This is ultimately paper one of two. The key purpose for this one is largely to try to set the scene, set out the key portfolio metrics and risks in the current situation, expected funding position as well, which Stephen's touched on, and then ultimately to try to gauge your thoughts on how you want to move forward as a committee, and also pick out some of the key strategic themes to take into the next stage of the review, and that stage two, paper two, will be closer in line with what you saw 3 years ago, looking at the alternative strategies, delving into the weeds with a bit more detail, if you can remember that far back, everyone, or if you're involved in the committee back then as well. I will maybe skip over the first couple of pages as it's largely around markets and some of the parts that Stephen just picked up before, but jumping on to page 81, this is a timeline of the investment strategy changes that have been undertaken since the last review. I won't read through each one, I won't cover this in a lot of detail. I think the key point I want to bring out really though is that this isn't a set and forget strategy. You set the investment strategic asset allocation 3 years ago, but where there is opportunity or necessity, for example, to change within the valuation period, you have had scope to be able to do so. Moving on to page 82, this is looking at the current asset allocation. Again, I won't spend a massive amount of time here. There's a pie chart or a bit more of a donut to the left. I think the key points that really stand out. There's a relatively large chunk of green on the right. That's the equity allocation. In the context of just looking at the portfolio, it looks relatively large and you are currently overweight there. However, this has been a key driver of return for the last 3 years. It's done well for you despite the Morgan Stanley investments. And in general as well, this is broadly aligned, if not slightly lower than the wider LGPS. So a couple of points to take account of there. The other point you know on that chart, looking at the rest of the portfolio, this is really well diversified. You've built that up over the past 3, 4, 5 investment strategy review cycles, largely to manage risk and reduce, or increase diversification, reduce overall correlation to certain market movements. Looking at the table, I'll pick out a few points. Based on Izio assumptions at 31st December, you have a portfolio expected return of 8.3% per annum. That's a strong margin above the 5.3% discount rate, and as Stephen touched on, there's a high probability of outperforming that discount rate. I'll maybe touch on value at risk next, but other points are inflation protection is a figure that we've included in there. The majority of your membership is inflation linked. Over time, we have looked to build out inflation protection to some extent as far as possible. That figure in the table is based on your exposure to UK real assets or infrastructure, things that you would expect to move over time as inflation moves. It's not a perfect link, but over the longer term, you would expect some protection there. At high level, we think there probably is scope to try to increase that further to help manage risk, but I'll maybe touch on that when we get a bit further through the report. The last point I bring out is your level of exposure to illiquid assets, which sits at 22% at the minute. You are a long-term investor. You do have scope to increase that further if you do want to diversify your growth exposures further. I think as a broad rule of thumb, around a third of your investment portfolio is where we would be comfortable, so around a third to 35%. The benefit of having exposure to these illiquid asset classes is that it diversifies your growth exposure to some extent. So rather than having a larger exposure to public global equities, which can be volatile, that whole chunk of equities would be correlated with each other. You are increasing your diversification there. So again, we think there is scope to increase that further to some extent. On to page 83. This is a brief reminder, or to those of you that weren't around last time around or haven't seen this before, of ultimately what value at risk is. It's a measure typically used in the industry within consultants, but also more widely as well, to try to put a measure on the level of funding risk inherent in the strategy. So the figure itself, trying to strip it back as far as possible, is how much surplus you can expect to lose in the worst case scenario versus the expected position over a certain time period and with a certain degree of confidence. So ultimately what we do is we project the fund's funding level over a number of years using a number of assumptions, using our in-house asset liability model. And based on a very large array of output that does come out from, I think it's around 5,000 simulations that we use, we get a best estimate assumption and projection. So that's, if you look at the chart there, that's the median line in the middle. And then you have a best case or very good 95% projection at the top, and a worst case scenario, very bad 5% projection at the bottom. Value at risk, put simply, is essentially the difference between that projected median best estimate position versus that 5% worst case scenario point at the bottom. That makes sense. So that hopefully sets up the next slide, which is the value at risk for the London Borough of Hammersmith and Fulham Pension Fund. So that total figure we have calculated at around 500 million. There's a lot of assumptions, there's a lot of moving parts, so I think the accuracy of that figure, take with a bit of a pinch of salt to some extent. I think if we were to model it again a number of times, this might change by a couple of million either way or even further, but I think where it's most useful is comparing the risk levels between different alternative strategies, which we'll look at in paper 2. So I think on a like-for-like basis, you can see which ones are more or less risky, which can help drive the decision, but also attributing where you're actually taking the most risk, which is what we have tried to set out in this chart here. So in this chart, this is essentially our attempt at attributing where you are taking most investment risk and funding risk as well. The two key contributors there are that large red equity exposure block there. At the minute, you have around 47% in equities. It's what we call rewarded risk. So you are exposing yourself to equity markets, which can be volatile, but you are expecting to receive strong investment returns as compensation there. And the only other point to bring out there in the red is the inflation point. So within your liabilities, you have unrewarded risk in the sense that, as I touched on before, you have a very strong inflation linkage there in your benefits. So this is unrewarded in that you aren't necessarily receiving a return in your investment portfolio for it, and all you can really do is try to mitigate that risk as far as possible by investing in more and more inflation-sensitive assets. I think a key point I would bring out is the attribution here is broadly typical of the LGPS. The only key changes really are your equity exposure is potentially lower than the average, and that diversification bar, which is the green bar to the right, I would say that's potentially wider than some of your peers. So diversification is, I would say, your key source of risk mitigation. You invest across a number of different asset classes and sub-asset classes. These all react in a different way to different market environments. As I said before, you've built this up over a pretty long time period, so we wouldn't recommend that you bring this level of diversification down. I feel it's a good risk mitigation factor to include and to maintain. The next page, I will touch on this very lightly. This is focusing on cash flow. We've included a table there. Ultimately, the key point is based on current employer contributions versus all your outgo, you are in an estimated cash flow deficit of around 18 million each year, based on some information a couple of months back. That's currently met primarily by income from the investment portfolio itself, excess cash balances, and where possible, disinvesting from overweight liquid positions where necessary. So overweight equity positions, for example. As Stephen mentioned, your employer contributions are going to come down, but not by an as material amount as some of your peers say. So I think what we are going to do as part of paper 2, we're going to undertake a bit more of a detailed cash flow analysis to ultimately try to understand what the underlying figures are there in terms of cash flow requirements, but also income available from the investment portfolio, and work with Sean, Phil, Max, the wider office team, just to really delve into what that figure is and use that figure as one of the key pillars to drive the wider review. But this has worked, I mean, Sean and Phil might disagree, but this has worked relatively smoothly over the last 3 years. And it's something that we don't envisage there to be a requirement to change too much going forward. The next 2 slides, this is more of a high-level portfolio look-through, looking at the different asset classes you currently do have exposure to. Again, I'll try and be as high-level as possible. I think the first block, equities, you've got a 40% strategic allocation. That's currently at around 47%. Largely driven by market movements. Equities perform really well, so having outperformed the rest of the portfolio on a like-for-like basis, that has increased in terms of the portfolio asset allocation. We would at the very least recommend you rebalance that. On a look-through basis, you are in the process of transitioning to 100% passive. So previously you had about 2/3 in passive with Legal & General, and the rest of that with Morgan Stanley. So when that transition goes through, you're going to see reduced fees, reduced manager reliance as well. Where this does leave you is there's a bit more of an overexposure to the US, general valuations in that market, technology as well. So we do think there is merit in continuing to diversify your growth drivers, whether that be through the equity portfolio inherently or through looking at some of the liquid products that you've considered before, such as infrastructure, renewable infrastructure, that type of thing. Dynamic asset allocation. As part of that, you do have a 15% allocation to buy and maintain credit. That's a very strong source of income to help meet cash flow. The only comment is in the current market, or if you take it back 3 years, credit spreads were quite wide. So relative to investing in government bonds, you would expect over the longer term to receive a premium on this investment. which to some extent has fed through. At the minute, though, credit spreads have tightened materially, so could be viewed as a bit of an asymmetric risk on the investment grade exposure to corporate bonds there. What we see here is an opportunity to take profits within this by maintaining portfolios to some extent. However, we don't think, or subject to discussions, there could be merit in maintaining a proportion of this allocation, recognising how much income you are still receiving there to help manage the cash flow books. If you are looking at alternatives, there are some different options within the fixed income market. So one alternative option is index-linked gilts. This adds direct inflation linkage to the portfolio, so it helps to balance one of the key factors I brought out at the start of the report. In addition to that, index-linked gilt yields are particularly attractive right now, so potentially a good time to move in. And then aside from that, if you're looking at the different areas of the credit market, multi-asset credit as well, or private credit, there are opportunities to gain there, we would think. So with multi-asset credit, managers have the capabilities to invest more across the wider credit spectrum in terms of different regions, different levels of risk, trying to seek out return on more attractive yields or spreads. And then with private credit, you would expect less correlation with credit spread movements and yields, and over the longer term, to benefit from any liquidity premium there as well, similar to what you are getting with your renewable infrastructure allocations. I'll touch on the last 2 points very quickly. Secure income, you're currently underweight there. The Partners Group Infrastructure Fund is in runoff. You are limited with options there on the basis that you will be moving to the London CIV. So there's merit to looking at the London CIV infrastructure, renewable infrastructure products there, but at the same time, you don't necessarily have to maintain this infrastructure allocation. So we can look at that hand in hand based on our views. The multi-sector private credit fund, you're in the process of exiting that. We'll update you on the progress there as part of the quarterly update as well, but there's a case of considering alternatives there too. And in addition, there's the Darwin fund as well. I feel like every meeting we're reporting on issues there. So there are limited options for exit, but this will be passing to the London CIV's management over the next, by the end of the month. So it'll be interesting to see what their thoughts are there, and if there is anything they are able to do with that. But over the period where you are locked in, it feels like there's limited scope to do much there, in all honesty. The final points in there, property. In general, property has underperformed equity markets. Where we see adding value here as part of our paper too is a combination of looking at your exposures here. So in terms of looking at the long lease market, ground rent market, and residential as well, both in terms of the underlying funds, but also in the context of the wider market and the outlook there as well. And separately, looking at what the London CIV options are there too. So if the decision is to maintain these allocations, it's likely over the longer term for these open-ended funds, these will be moving under London CIV management. So it's a case of considering what those funds look like as well, I would say. The very last couple of slides I'll cover and then open up for questions. Page 88 and 89. And these are what we view as ultimately the key levers to the strategy review, or the key points that we would look to take forward into our second paper. The overall risk versus return profile, we think, is a key decision to drive our approach, and ultimately depends on what your investment beliefs are, but also driven by the actuarial valuation results as well. You're in a very strong funding position, and that's with a pretty prudent discount rate as well. So plenty of scope to de-risk to a certain extent, which would be aligned with the additional prudence taken on. That said, at present, you are one of the most de-risked in terms of the wider LGPS. So there is a thought there. Do you want to maintain the current return profile, or even increase that to some extent? That is an option. Or is it a case of looking to maintain the current levels of risk and try to drive returns further too? I think our typical view, and it'd be good to get, obviously, open discussions with you to see your thoughts there, but our typical view is to seek efficiencies as far as possible. So at the very least, we wouldn't be suggesting to increase the risk position there. So ultimately, it'd be good to get your thoughts on how you want to drive the strategy in this regard. But I think with that in focus, where we would look to move forward as part of the next point is to try to balance this against some of the other key pillars that we've highlighted over these 2 pages as well. So cash flow, as I mentioned before, diversifying your growth drivers. So as I said, you've got a chunky exposure to equities, which could be deemed risky in the current environment, and the scope to take more liquidity as well. So that could potentially go hand in hand. And there's also inflation protection as well. So whether that's in direct through the real assets that you're exposed to, or more direct through something like investment gilts as well. And the final point, ESG. You've already done a lot here through ESG tilts and renewable infrastructure exposure as well. The question there is, do you want to try to push this any further? I will stop there and open for any questions. Apologies, I've spoken for a while there.
So, very much appreciated the summary. Just to double check my understanding, John, and very much welcome the advice of officials and advisors here. Am I right in making a couple of statements that we've got a higher funding level than our peers, an average peer? We are more diversified within our investment portfolio than our peers, so less exposed to risk. Though there are some clarifications within that in specific allocations. And that's expressed through a lower value at risk than our peers. Have I understood those correctly, or?
The last two I would agree with. In terms of funding level versus your peers, there are some of your peers that have had, over the last few years, a much higher allocation to equities, which has pushed them a fair bit higher in terms of funding level. But without the gap in the government actuary department analysis that Stephen touched on, unfortunately, this doesn't come out for another couple of years, the final results. So it's useful to look at it when that is available, because you can kind of see on more of a ranking basis whereabouts you do sit. But in reality, I would expect you are sitting in and around the middle, if not pushing above. Yeah. But I think the key point there is on a consistent basis, it is tough to compare yourself versus peers, whereas in reality, you do have a prudent funding basis, and the investment strategy has been set to improve funding, but minimize funding volatility over the longer term relative to that. And that's part of the diversified portfolio they have built out.
The sort of overview top line is that the strategy over the last 3 years has been a success, and that we have the opportunity with this discussion to kind of fine tune it, rather than, the advice is not to make dramatic changes.
More evolution rather than revolution. In terms of calling it a success, I think from a strategic asset allocation perspective, I agree. Some of the underlying implementation aspects, as you've seen with Darwin, that type of thing, at Morgan Stanley, less of a success in terms of shooting the lights out, but has helped. As you can see, the asset value has improved materially over the
So then the questions then become to members is in that sort of fine tuning exercise to inform that second paper and our further discussion. Is a thought around how aiming for it. How much do we want to fix it? Is there a further appetite to take on additional risks which could deliver further return and further security for future managers of the fund? And there's a number of options that you've outlined for us for us to do that, which have pluses and minuses. So correct me if I've misunderstood, but there's the option to boost the equity allocation, which we're currently below the sort of industry average on. There's the option to diversify growth drivers, including looking at illiquid assets and as well as the hold for a bit longer. The option to increase our inflation protection, which would take us in the opposite direction, right? That's a sort of less of a growth driver. That's a risk management opportunity.
Can I start with a slightly more meta question?
Of course.
Taking a step back. I mean, you've got a slide on the pooling regulation anyway, but given that from the end of this month, some of that decision will be taken out of the committee's hands, how much impact will that, whether it's fine tuning or whether it's kind of more, which I agree we shouldn't be kind of making drastic changes, I'm more I think on the line of your steering us to, but is there a huge amount of scope for us to diversify given that so much of it's going to be pulled?
Can I give a view on that, and then I'd be keen to hear from advisors, officials, and staff in particular, is that I think this is one of our sort of last opportunities prior to that pooling to kind of set the agenda, and that this strategy is an important tool to, on the future committee to have that conversation within the pool. So I do think it's an important exercise, and that some of the Zenitors that I'll have a last chance to shape that conversation. So it's perhaps a bit more important than previous reviews of the strategies and communities to find more opportunities to do so. Does that mirror advisors' view, Sam?
Thank you, Chair. I think absolutely it is a very important, and there's probably more importance on getting this right. But right isn't just about what the asset allocation outcome is. It's really also about how we are empowering officers to communicate with the pool. There's that slide that Sierra put together on pooling regulation just demonstrates what a blunt tool the government envisages for. I'm not sure if it's been done actually, but I'd love to see how our current asset allocation would map into this, because I don't think it's fit for purpose. But that point has been made multiple times and they don't want to change it. So we're going to have to work with it. The pools, all of the pools, but in particular the London CIV from our perspective, have committed to that they're not just going to anything that doesn't look exactly like that box they're going to throw out, right? They are committing to working with you, but they don't quite know what it looks like either yet. So the better positioned we can be now to engage with them, I think that is absolutely the right way to go on it. So that's sort of in terms of the structure of the conversation. I think in terms of where my sort of tuppence on where we might think about going, I think you're quite right that we don't want to do radical change. The world is a very, very uncertain place, and any change is an active decision to do something which you can regret or otherwise. And so I'd be really looking for a balanced approach to all of that, and I think all of the relevant issues have been drawn out in these papers. And as it's not rocket science; it's been done many, many times before. But I would encourage that we think about things like there is a huge overweight on the equity book right now. Actually, I mean it's 6%, but that's more than 10% of the. It's only supposed to be 40. Right? So we're talking about 15% overweight to our allocations. That's meaningful stuff, and it's for good reasons now. But that could also be for very bad reasons later on. If it all goes wrong, then we really want to. So we need to get on top of how the oversight of that rebalancing and the like is. I think we're also there's been a long-standing push across the industry, and now it's been backed up by government to get into more and more illiquid assets and private markets and UK investment and all these things, and pushing retail money to do the same, and wealth money and DC pensions and everybody doing all this stuff. And I'd also just want to be very, very careful about how we consider those asset classes, because they are very, very different beasts. They have very different roles in the portfolio. And whilst some that we are already exposed to, infrastructure for instance, it's perhaps more obvious to understand what it's supposed to be doing for our portfolio. Some of the others, in terms of private equity and private credit in particular, there's some big questions to be asked over the viability of those asset classes over the short term. And we don't, if there's let's not just pile in because we're desperate to get some sort of diversification. I think that's probably high level thoughts on where we are. But we'd also, be looking at, I'm sure, for the next paper to be bringing out a lot more of the detail on these things. And so, as I would frame the question now, it's more about, are there any of these areas that you think actually that's not really something we want to get involved in, that decision, rather than trying to pick out the ones you do at this point, because there's going to be a long list.
Thank you very much for this contribution. So I just wondered whether, going back to your point about the second paper and this, balanced approach to this. I mean, we are sitting here tonight while, the world is fundamentally changing, and there are implications for that, for risk in investment at the moment. And I would urge caution. And not just because of that, obviously it's key. I mean, inflation is likely to go up. So, and you don't yet know what is going to happen to food and petrol and all that kind of thing. So, I think we are in volatile times, as you said, and I think what Sam said there is important, that we get our act together here, moving forward, because we are a good. Well, he would win awards, and we should be showing the London SIP, a way forward sometimes, and I think we should be preparing the ground for that. I am concerned, and I'll raise this now, I'm concerned about general accountability, actually, local democracy, moving forward. We're going about some other matter. But, and the other thing I think, I asked this question at various events I've been to, and I haven't got an answer, and I don't think anybody knows yet. But what does local investment mean? I don't think anybody really knows that yet, do they? And I mean, so you're right to say we need to get into this new game, and we need to then realise what the dynamics of it are before we do anything. And so, I mean, would you have written these strategy themes for consideration slightly differently if you were writing them tonight, as opposed to what's going on in the world at the moment about risk? And you say we're a long-term investor, and I respect that, but or with the inflation protection, that's what I'm asking. So, given those dynamics, I would sort of have a more, steady as she goes approach, with knowing that what we have done in the past has been not perfect, but it's been pretty good, and we shouldn't deviate from that too much at the moment, because I think there are risks out there that we might not know yet what they are. to investments. And I'm a great believer in investing in this country. Yeah, I am. So there's some part of me that thinks some of this way forward is positive, but I'm still not convinced that anybody quite knows what local investment means, and we shouldn't be making the wrong decisions on that, or allowing others to make the decisions for us. And that's really why I think it's important that we are having this debate tonight, and we're getting a firm way forward, so that we're in a stronger position, for all of us, but also for our members. So I think I'd echo what Sam said there, really, for you, Johnny. Thank you.
If you permit me to paraphrase some of that to Peter, so you're in favour of further caution to insulate the fund against unexpected changes that are ongoing, and you support in principle are not yet reassured of the detail of some of the sort of investment guidance that we're receiving from the central government.
Thanks, Jen. I think I agree with what everyone's said broadly, but on the point of diversification, I think we've been following the strategy for long enough that we've actually got some good data on this, and I wonder whether it might be worth actually not challenging but checking that we're actually getting as much diversification as we think we are, because part of it, I'm sure, is because the private investments are not to market less frequently than public ones. So when we've seen the volatility that we've had over the last few years in equity markets, that doesn't always flow through into what we see in our private valuations, or at least it's delayed, and by that time the markets might have bounced back. So I think it's probably worth asking ourselves whether there's a bit of a reporting factor around that. And secondly, I think the lessons we learned from Aviva and Darwin, and possibly to a lesser extent Alpha, is that what happens in the wider world does affect these investments. And I was really angry that Aviva basically sold us something on the premise that it was infrastructure, and then turned around when it underperformed and said, well, of course, gilt rates have moved, so you should realise that. So, none of these so-called diversifiers are immune to what the wider economy, the global economy is doing, so we should remember that. In terms of equities, yes, it is a big mismatch against the allocation, but I would say personally, I think maybe we cut that too far, and that 40% for a fund like ourselves is quite a low benchmark, and maybe we can consider actually marking up the equity concentration. That would just be my own personal thought on that.
So that's an appetite for greater risk.
Well, I don't know whether it increases the overall risk, but in terms of the asset class versus other asset classes, I don't think we're overexposed to equities if we're around 45% rather than 40%. And just another point regarding, it is a very uncertain world, and we're seeing what's happened in the last few weeks with private credit in particular, some bad things emerging in some of those funds that generally locking our money away for 5 or 7 years is, we are a pension fund and we can take a long-term view, but if we change our mind, it's very hard to get out of these funds for anything other than buy sell price. I would have guessed we have more than 22%. I would have guessed we were closer to 30%, but I can't say personally I've got a great appetite at the moment to see more of our money tied up in funds that we won't be able to get out of if the world change.
Yeah, no, that definitely makes sense. I feel like the last point, the pension fund itself has had bad experience with locking money away, as you say. Aviva, Darwin, the MSPC fund more recently as well. So that's something we definitely take into account as we go forward. I feel like there's a lot in the context of proportion. There's a lot less horror stories across the investing universe than we do tend to see, which here, which whether that's bad fortune or whether selection, it's hard to put a finger on it. But I think going forward, if you are taking a liquidity, this is within the London SIP remit now. So where they tend to take this approach is in general more a fund of funds approach, which does reduce your exposure to individual manager risk. So I would consider that as you move forward, but I definitely do take your point on exposure to the liquidity there.
Thank you, Jeff. So where we are, obviously the main theme that's evolved from this presentation tonight, that the fund is very well diversified, and we are told that good practice comes from diversification. It's supposed to risk over a long period of time, protection against fast movements in one asset class, which is you've got many eggs in many baskets. We could look at Kensington and Chelsea, given that we would be on one end of the scale, probably the most diversified fund of the RGPS, apart from the Flintshire fund. And then at the other end of the scale, you've got Kensington Chelsea, 75% in stocks and shares, 25% commercial property, that's it. So their view is based on solid rental income stream from UK commercial property, which is bricks and mortar, inflation hedge, and a long-term bet on equity being the outperformer over the very long term. And RGPS is a long-term pension fund, so can afford to take the volatility, the ups and downs, and smooth out increases over the very long term. Where we stand with the new arrangements, the SIP will take over responsibility from the 1st of April. As a committee, we still have responsibility for asset allocation decisions. And I think there are 9 buckets, which are broad asset allocation categories. So in terms of SIP takes over, they will look at LBHF's portfolio, allocate all those different asset classes into various buckets, and then from the 1st of April onwards, they will have responsibility for managing those assets. When some of those portfolios wind down, you've got a full cash distribution, they'll take the cash and they will make a decision in the future as to where those funds go. The committee won't have that tactical asset allocation decision making. So in terms of this paper, as Johnny has said, there's a chance for a discussion on themes in the investment backdrop at the moment, where the risks are, how we should be allocating our assets according to the basic future investment risks, keeping that diversification quite varied and significant. But that responsibility for tactical management decision is on the SIPs, and we've got to bite the bullet on that one. So, and then we're also thwarted by the fact that the new legislation will prevent us from taking ISIO's advice from the 1st of April. Now, I think there will be a crossover period, probably for 6 months, where ISIO and Johnny can wind up in terms of completion of those projects that they've started. So this investment review, which normally would start at the next cycle, we would get this valuation out of the way, and then the next meeting would be the investment review. So we started this early because we know we will have to wait for advice from ISIO soon. So that it will be legislation that will prevent us from appointing for advice. We will have to go to the London SIP for strategic asset allocation advice. Now, we're not sure yet how that's going to work. The SIP has appointed Mercer to help in that provision of advice, but we don't know, not even Mercer knows how it's going to work. So there will be that grey area in terms of the transition period that you will be required to take investment advice from the London SIP, which is a worry, because in my mind that's a conflict. You can't give advice and then implement the advice. It must be done separately. We've been complaining about this over the last 12 months, and we really haven't got anywhere. That also applies to scrutiny and oversight. Again, there's not a clear arrangement. SID possibly marking their own homework in terms of giving us advice on scrutiny. We've done this for you, but not having independent views. So there are these grey areas which we have to work through. But the first project is to complete this investment strategy review, take the ISIO recommendations, get the approvals from the committee, decide in terms of the 9 buckets, investment buckets, how you want your assets allocated, so there'll be a percentage provided for each one, and then be prepared to work with the city in the future as to the implementation of your strategy.
So what's the timeline on that? Weeks. If you're saying that we're going over to the SID at the end of this month, we're waiting for a second report back to determine our strategy. But at the other end, they're not properly ready yet, what you're saying. I mean, I won't quote you on that, but I can understand that. Therefore, we've got a time imperative, haven't we, to get this done. There's also got council elections coming up, and a period of pre-election period. So we're talking about doing this very swiftly, aren't we? To turn around your second report and us to agree. I don't quite understand what these 9 buckets or pockets are.
Can I address that? There are lots of moving parts in terms of what the pools are being asked to do going forward. If we were to do nothing, then they just take over responsibility for what we've got now. So there's not a hard deadline at the end of the month that if we don't tell them something, then it's all going to fall apart. That's not to say we just got forever, because the whole point of engaging with them is try and do it early rather than the other 30 boroughs have already done it and we're the last one, and then you get less chance to shape things, right? That's the key. So it's not that we've got to turn this around super quickly. I imagine the timing is to come back to the next committee with this second paper, right, and take decisions from there.
That's been the plan, yeah. So other pools, for example, have given a fair bit more leeway to kind of work with us to actually reach a full decision with the committee to try and strategic asset allocation on the basis that A, they're not ready, and B, a focus on collaboration with the underlying partner funds like yourselves. So
perhaps I wouldn't be surprised if we didn't have a London SID strategy person sitting next to Johnny when the next paper comes, for instance.
It's generally going to be a 6-month window where all the changes required, which include lots of other governance aspects, which is a further paper in this agenda, but 6-month window to implement all of those. And I think you can apply this investment strategy review, get that done and dusted at the next meeting. It's probably be the June committee cycle after the election. Agree the way forward there, and then basically hand over a position statement where we stand at the end of June, or possibly, it would be the end of September. But to hand over that position statement with the desired asset allocation buckets, and then say, over to you.
Here's the case.
Here it is, and look after it.
Yeah.
Comes back to your question. I do think this is valuable for us to give that application. So,
and it's actually, sorry to jump in there, I hope my question didn't seem like I was suggesting it wasn't of value, but it's good to know kind of actually how what we do now can have that sort of future impact on shaping the SIV, because I think probably all of us here have had questions asked of us by residents about particular investments or type of investments. And so far the line has been, it's about to be pulled, so we may be limited, but actually we've still got that ability to kind of shape, even if it's not the sort of, not so much thinking about the figure of what's in what bucket, but actually being able to give a bit of a narrative steer as to what we want to prioritise. That's helpful to know.
You hit the nail on the head that our tactical abilities will be minimised on the SIV, but we still have a strategic voice.
I do completely agree with that. What I would probably say is, yes, you're going to lose your ability to have, say, these tactical allocations outside of these 9 buckets, but this is potentially the last chance to really set out your preferences with as much granularity as possible. So I encourage you to set out as much clarity as possible. So at the very least, if one and say that are happy to collaborate and move forward, then you do have
going from a position of kind of information.
Yeah.
So then, Johnny, what do we need to proceed on this? You set out these questions for us, and I think we've kind of arrived at some of the answers that are. So on the first one on appetite for kind of long-term risk, does feel like the tone of the theme is that the committee is kind of concerned about upcoming volatility, so are interested in exploring opportunities to protect and mitigate from that. So we'll be looking for options about how we can always stay that. Key strategic themes. We've only really touched on it briefly, Anna Peter, with your comments on local investment. We also spoke about ESG briefly. I assume that there's both still interests. I'm personally be keen to hear if the rest of the committee agrees. Personally, very, very supportive of the allocations for UK low carbon infrastructure as much as possible. I wonder if this is a kind of moment to elucidate some of the conversations that we've had with some of our protesters over the past 6 months, to highlight as a strategic thing, minimising our risk of exposure to high risk investments, particularly in arms of those exposed to ongoing conflicts. So I think it's appropriate for us to reiterate that within this section. Is there anything else that we'd like to flag?
Well, I'll just echo that last point that the Chair's made. We need to have that quite clearly stressed. And I mean, it did come up in an earlier report, we had that diagram which showed that climate. And I think if we are showing where we're investing ethically, perhaps demonstrating that slightly more clearly, that would help us. I think in terms, we have had, I think you need to know that as councillors, we have had a lot of correspondence. Some of it's coordinated, but nevertheless, from residents about the issue, and we'd be not doing our job if we weren't reflecting on that. And we have actually contacted them. We came to an agreement about how we were going to do that, which anyway, we've done that. So we can, because going back to Eleanor's point about communications, we believe that's a very important part. But so I think that lines of that going through the policy and the next statement would be important for me. And I echo what the Chair just said. Thank you.
Thank you, Chair. Johnny, is there scope for under strategy themes for consideration where it says diversity growth drivers, that the fund has scope to take a higher level of liquidity? Liquidity assets can offer a similar level of returns to equities alongside income and diversification in that box. Is there scope to look at that in our last chance? Before we
Yes, yeah. On the bit, so this kind of goes back and forth with my comments before. But if you If you do look to increase that liquidity, you are locking away those assets for a little bit longer. But what we can do is we can come back with a couple of alternative investment strategies that we kind of set out a couple of different goals. So one was similar return de-risk, another one echoing those points around increasing equity. We can see if we can build up the equity exposure, but either broadly maintain overall portfolio risk or reduce risk, for example. And then I can definitely set out a wider point that looks at increasing that liquidity point as well to be broadly more aligned with the way I should get.
And just to recap on the diversification, I think we should just make sure we're not diversifying for our own sake. Just ask ourselves, what are we trying? Are we getting this? Are we actually getting less market beta than we would have done? And why is that? And to what extent is there a timing difference in the way it's reported to us?
Yeah.
Is there a sort of qualitative assessment of diversification?
Because we have been doing this for 10 plus years now. So
yeah, no, I think that's a very fair comment. It's something that we can build out for definite. Yeah, because I think in terms of the underlying assumptions, based on forward-looking analysis, that's exactly what it is. It's forward-looking analysis based on a number of assumptions. So yes, you are building out diversification in that sense if you take a snapshot in time, but I agree with you, it would be very helpful to see how that beta has been driven over the last how many years.
Sorry, Chair, this is just a side issue. So with the London, in 17 days time or 14 days time, the London City jump in, there is no, can a committee say something like, thank you very much, London City, for sitting there. We'd also like to retain, can we do this, can we retain some services like this? Can we as an independent, because that are known and complete?
in regard to public regulations, that we will be prevented from taking additional consultative advice apart from the London City.
And I assume the justification for that is the minimum cost.
It's a cost now. Yeah. And it's unfortunate there are suspects out there who spent a lot of money on consultancy. And that total bill across the RGPS has added up quite significantly. And it's under the spotlight. So there are sensible funds, and then the ones who spend, there's one London borough that spent upwards of £600,000 a year. We can't really work out how that's happened, but it's being drawn to attention, and therefore it's like there's a solution to the problem, but we apply the solution to the whole of the energy.
I think just to add, there is a line in the latest guidance that says you can use investment advisors like consultants in extenuating circumstances. I can't think extenuating is the right word, but what that means, no one knows just yet. But we'll be happy to be on hand if that is. I'm sure. Yeah. I guess there's a side part Sam will still be here. So
I might also just probably got a comment that would need to come in closed session rather than open.
Thank you all. Is there anything else that would be useful to, or anything else from the members? I think Peter described it very well as the last chance saloon. If there's anything you really want to get off.
More of a general question, but do you have any sense, Johnny, of how other boroughs, kind of how far they are down this line? Because I know you said obviously sort of the sooner we get in, the more influence we like to have, and I like to think in H&F we definitely think that we lead the way on a lot of these things. Is there a chance for us to kind of be particularly influential?
To some extent, yes. I think in terms of how far you are along versus other London boroughs, other partner firms, I think some London boroughs have gone by the book as much as possible. They've been told they need everything done by 31st of March, so they moved early, kind of ignoring the actuarial valuation, which there's pros and cons with doing that. I think of the London boroughs and wider LGPS that have tried to align with the actual evaluation as much as possible. You guys are very much at the front of the queue, so in terms of yourselves, Westminster as well. So yes, in terms of moving quickly, in terms of being influential, that depends on the London City's take, to be honest with you, and I can't comment with any real certainty.
No, that's fair enough.
I think the strategy that fills out on kind of making our views as clear as possible, as early as possible,
Yeah.
is the best opportunity we have here to exert that influence.
Absolutely.
Is there anything else that you need to take for that second report?
Nothing from me. That's genuinely a really helpful discussion. So thank you, Chair. Thank you, Committee.
So I look forward to the second part of it. Item 9, pension bill update, please.
Thank you, Chair. As has been requested by the committee previously, this paper provides an update on the pension schemes bill and the associated changes to LGPS pooling, governance and regulatory requirements, as well as the fund's progress in preparing for implementation. It highlights key implications for the fund and the actions required to ensure compliance with the evolving legislative framework. I now invite any comments or queries.
We've referenced this in multiple reports so far. So I know I've had a chance to comment on the question already, but there's something that haven't. Chance, please,
Yes. I just wondered if anybody can enlighten me a bit more about how this is going to work. I don't want to repeat what you said, but this independent person, I've heard that term. I mean, what is that? Is that an independent? Would that be at this stage, or would it be at whatever the London City are going to set up? They're going to have a board, are they sitting above this? Is that
independent person advises this committee and that's
right? So that is mentioned because again, I heard some things said about whether there were enough independent persons to go around and all that kind of thing. But so we're secure. We have a right. That's very what I'm asking. And then so it goes then up to the London City board or whatever it is, and we can then still be pushing up to them our very strong views on what we're doing about investment. But ultimately, they can overrule us. Is that right?
We send our views on our strategic asset allocation. Right. So our percentages to what we want to invest in the various opportunities.
Yes.
Sub-funds, which cover the whole spectrum of investment. We divide into 9 areas. So that's our high-level choice as asset allocation. Right. And then it's down to them to decide how to implement.
And will we have anybody from here on that board? Or how do we go? I'll go back to my earlier point. I mean, there's a chair on the board. There is, change is change, isn't it? It's always going to bring issues. I do worry about the loss of local accountability. I do really worry about that. Democratic accountability as well, which we try to do in this group. And I think we do quite well. I think the chair does extremely well. And just going back to where we had to go to residents who are concerned about our aspect of investment, recently, which was quite difficult. The chair did extremely well on that. I think that I just worry slightly that what that might look like in the future. But so we're not going to have anybody from here feeding into that group. Is that?
There's various bodies of the CIV, so there's a shareholder representative group, the AGM, one representative from the chair who sits at the AGMs and various items that go through on the vote. And then there's another body which is 4 London treasurers, 2 officers, two other representatives on how the CIV is run. Used to be 32 reps, one for each borough, but that was too many for an efficient way of running a body like that. So it went down to 8. That still exists. And that basically advises the CIOs to various points of governance and how that government should be implemented. So we can still feed in. I mean, LBHF will feed in its high level appetite in terms of just very, very basic investment allocation. But all of the tactical manager selection, everything switches across to the CIO. So this will be the last committee meeting where really we have any choice on managers.
But moving forward, sorry, Kev, do you mind about that? Is this tri-borough relationship that we've got, is that going? Will still be working out? Oh,
Nothing changes.
nothing changes, so that's good. I think that's good because I think that's a strength. I really do, and I've seen that in evidence of various things I've been to. So it's good, right? So there, things are not changing fundamentally, but here they are, and the power is there. Right. Okay. Thank you.
The points that I made, Peter, that this is the last sort of executive meeting. You know, we'll move to a strategic goal. The chair of this committee was attending the AGM. I will be one of the board's officers. I think there is reasonable concerns about it and accountability, but that we shouldn't persuade what new structures and processes might be put in place over the coming
year. Yeah, okay. Thank you. Where is it in the Stockholm? It's supposed to be legislation first of all. It's got held up. It's got held up. That was the time question. Sorry, Chair, I was asking questions.
Good question.
May or June?
May or June, you think? Right. Okay. But is it going to go through the House of Lords first? Easily, do you think?
I read this week it's gone into report stage at the House of Lords, so one of the final stages. And then we'll go back to the House of Commons. And then the regulations have to be drafted and submitted and then commented on for consultation. So there's still a bit of time.
And if you'll permit an unmunicipal comment, Peter, if you think there's going to be parliamentary time after the meeting, I've got a bridge to sell you. Any further questions or comments? Excellent. Can I ask then that members note the report on pension scheme bill changes? Thank you. I suspect there will be revisiting this. Staying with you, Sean, on to the open elements of the London Collective Investment Vehicle Investment Manager Agreement. IMA.
Thank you, Chair. This paper presents the proposed investment manager agreement, or IMA, between the pension fund and the London Collective Investment Vehicle, or the LSIV, setting out the legal framework for how assets will be managed within the pool, including the roles, responsibilities, and fee arrangements. It's a key step in asset pooling, and I now invite any comments or queries from the committee that can be held in public session.
A further explanation, Chair. So this basically is the blueprint as to how the investment operation runs according to a signed agreement between the London Civic and the London Pension Fund. So each of the 32 boroughs has to sign a version of this IMA that's specific to them. So all the appendices will hold the various asset allocations and fee schedules. So it's tailor-made for each borough. We've got the main contract shown in the exempt appendix. There are still revisions being finessed. So one of them is like with the dispute process, which is according to this, we have over 90 days. So the general view that that's too long. We need a dispute process that can be finalised quicker than 90 days, so down to 30 days. So that will be a revision to the document, which, in terms of how we approve this, the recommendations that the final document is agreed between the chair himself and the recommending that this is the final version we sign. So it enables that finessing to take place. But it's basically the engine of how all of the investment processes will take place. That's carried out.
Two questions then, Phil. Is one, can you, this is a bespoke agreement for ourselves, right? How's that going to work in practice if we have a sort of a particular agreement that diverges from any of the other 31? Are the divergences not so dramatic?
The divergences will only take place according to specific asset allocations.
I see. So it's quite within a specific area. Thank you. But the sort of broader use of it is template. So, and then the second question is on timing. I think this seems to be wrapped up.
Yes, ideally we need to get this in by the 1st of April. I would say according to when the legislation takes effect, because obviously without the legislation, these new arrangements won't have any statutory background. So if that was delayed, then we would probably delay the signing of the document.
I see. And we can take a view on whether that's advantageous. Mike, did I see you wanted to? Apologies. Any questions? Okay then. Can I ask members then to approve the draft of the agreement that's in the material? And then to approve delegation to myself, Phil, final signature of any agreement that then goes to the Senate. Thank you. I imagine we will return to this under exempt component of the meeting. I think this is the area that you wanted to come back in. Excellent. Item 11, pension fund quarterly update.
Thank you, Chair. This paper provides the committee with a quarterly update on the pension fund, including a summary of investment performance, cash flow position and forecast, and assessment of key risks and mitigating actions for the period to the 31st of December 2025. I'll hand over to Izio to take members through quarter performance in any required detail.
Okay, Michelle, thank you, Chair. It's late, I'll go through this very quickly. In terms of the total fund is delivered over the quarter, a total absolute return performance of 1.2%, which is 2% behind the aggregated benchmark, and over the year, that's behind the benchmark by 4%. So positive in absolute terms, but behind the benchmark. That's primarily been driven by the Morgan Stanley investment, which you are in the process of coming out of, and the Darwin fund, which I have touched on a few times in the past. This report is probably a little bit outdated now. We're nearly 3 months since, and I'm sure you're very aware of everything in the news surrounding Iran conflicts, that type of thing. So how that has impacted the portfolio. Equity markets, well, markets in general have been volatile. Equity markets have, it depends on your viewpoint, but I would say the falls have been a bit more muted than you would expect. Over the year to date, over the first 2 months, there's been a bit of a continuation in the rally. Your AI stocks continued driving returns, that type of thing. And then a relatively large drop off there to the year to date. As of yesterday, I think it was down maybe 0.2%. So the key logic there is wider markets have dropped off, but oil and gas pricing has bumped up a little bit, which is broadly maintained in the market. I've got one other update on the portfolio, which has come through over the last couple of days, and it relates to the Aberdeen Multi-Sector Private Credit Fund. So Aberdeen have now moved to liquidate that fund. You might remember, I can't remember the exact meeting, but thank you very much. The committee agreed to issue a redemption request from this fund. They've now had over 85% of the fund by net asset value seeking to redeem as well. So they've tried a few alternative methods to exit the strategy, to fully close the strategy. So that's included changing the fund's guidelines to try to seek interest from external investors, looking at the secondary market, restructuring the fund, but ultimately not enough demand to move forward there, and they felt that they have ultimately exhausted all other options available. So the most practical approach that has remained is going down this approach of liquidating the fund in its entirety. From the pension fund perspective, this means that rather than waiting on buyers and being subject to pricing constraints too much, cash, in theory, can be distributed to the pension fund on more of an ongoing basis as this does become available. Myself and officers and a member of our credit research team as well managed to join a call with Aberdeen a couple of hours before this meeting. Their expectation is that this can fully complete within around 12 months. So positive compared to what we've seen in the past. In terms of portfolio, at present there's about 60% in either liquid assets or cash. The majority of that they expect to be able to redeem at the next dealing date. The remainder is, the remaining 40% is in private credits, so less liquid, it can't be easily traded. They expect most of that can be redeemed in and around fair value based on expectations of buyers, that type of thing. They've got a few levers they can pull in-house around that type of thing. A good proportion of that is maturing over the next year, so they will likely just allow those products to roll off. The remaining 5%, I think it's a small portion, which I know there's about 5%, but they've flagged this will need to be sold or exited in one way or another. This might fall below fair value, but they don't expect it to be material. But it's a caveat that they are willing to share with investors at this point. So from our perspective, in terms of actions, they've set out a document to essentially allow them to enact this process, which needs to be signed and returned by the 2nd of April. They need 50% of signatures to enact this by net asset value. And ultimately, from an ISIO viewpoint, we feel this is the most practical way forward. If I'm honest, I'm not sure what other approaches are remaining without significant cost or significant amount of time. But ultimately, I believe officers can sign this off, but we do need committee approval to move forward. So happy to take any questions, but also Phil, you on the call, so if you have anything else to add.
Yes, in terms of where we were advised this afternoon by Aberdeen, obviously decision was taken previously to exit that portfolio, and we would have normally, if things had proceeded as envisaged, we would have taken a slice of those assets, they would have been cashed in, we would have taken our funds accordingly. Now there's a wholesale liquidation across everything, so there will be a fair distribution, but we do, in order for that to proceed, we need to provide our approval for liquidation by the 2nd of April, and that can proceed. They need, I think it's 75%
I think it was 50%.
Yeah. Of the funds, it's not the number of votes per investors, it's the value of the funds allocated. So it's a straightforward, well envisaged in terms of the committee approving that liquidation, which really enable the acting specialist to proceed with that.
Yeah. So not only have we got a few practical alternatives, but this is likely to go ahead without our approval anyway. We might as well.
So just for understanding, what's driving the timeline and therefore the need to potentially exit some of those underlying assets on a secondary sale rather than allowing them to roll off and be paid back? Is that an Aberdeen sort of, okay, the process is we're going to get it all done in 12 months? Or is that coming from investors? Do you know?
It's I believe, a combination, in all honesty, because most investors, I can't remember the redemption terms off the top of my head, but they would have expected funds back within the first 12 months. As an aside from that, though, the remaining assets, I believe, that sit into that 5% that will potentially be looking to be sold earlier, more long-dated than a year. I'm looking more, from memory, looking at the portfolio more towards like 3 or 4 years. So it depends if
It wouldn't surprise me.
Yeah.
That's what private credit looks like.
Exactly that.
Okay.
Any questions, reflections? We can take it as the two separate components. There's the sort of the broader quarterly update and then there's the annual specific. So I will take them in that order. Can I ask members then to note the update, the quarterly update? And then on the Aberdeen allocation, are members comfortable with us approving that wind down? That surprised me. And are you agreed to delegate to myself and to sign that approve? Excellent. Can I ask then that the committee resolve to go into closed session? Perfect.
Sorry, I'll second.